Oh, I think the market is right, and the market is telegraphing the Fed is on the wrong trail. They're focused myopically on inflation. That seems to be their goal, even though interest rates is a pretty crude tool to operate with that. And even though the numbers in the real world are weakening, the numbers you cited, in addition, housing is weak. We've seen extreme stress in the financial sector, and yet the Fed is still focused on raising rates when they should be doing actually is beginning to cut rates to provide liquidity and help correct the extremely rapid rise that they did. That it was the fastest rise in short rates in history, what they did last year, taking short rates from 0 to 4.5%. And that's why we have distress in the financial markets, especially in the banks.
All right, so before we get to a cut, they've got to pause, right? And that is where markets are now pricing in 60% odds of happening at the next FOMC in May. I'm wondering whether you're with that consensus for now, or whether, look, it's still we've got a heck of a lot of data to get through before we get to the May FOMC, including, of course, Friday, you've got the jobs report.
Yes. Again, I think the Fed, the biggest risk to the market is the Fed activity, the Fed continuing to tighten without recognizing that the economy already is feeling the effects. We're seeing a lot of the indicators roll over. Inflation indicators are rolling over, and still they're looking at tightening and ignoring the fact that the market understands that their actions come in the real economy with a lag, and we're beginning to see that lag, the roll down, and I think we'll see more of that when we see companies start to report earnings over the next few weeks.
Margaret, are there more bank failures to come? And if so, how do we approach the regional and the community banks?
Well, it's ironic that the reason the banking sector is under great stress isn't because they were foolish and they made really bad loans. The mistake they made was simply, during a period of basically zero interest rates, buying long-duration Treasury bonds. In other words, they bought the safest securities they could, and this is really what's buried a lot of the banks, having very long-duration bonds when we've had such a huge rise in rates. Because even intermediate-term Treasuries had price declines last year of 10, 15% or more. So it's really very difficult for banks to, in a short period of time, restructure the balance sheets, pay competitive rates compared to money markets, and that's really what's caused the outflow, rather than bad loans, which has been the case in previous market cycles where the Fed begins to tighten.